US markets just had their worst week of the year, and we need to talk about it because up until now it's felt like there's been a kind of FOMO feel, aka fear of missing out, aka investors have been holding on because they think it's going to be short-lived and nearly done. That seems to be changing. So what does that mean for you, your investments, your money, and who are the winners and the losers out of this situation? Let's take a look. Hi, welcome back. My name is Zoe and this is my channel Words on Wealth, where I break down some of the key headlines into what they mean for you, your investments and your money, and just making things that little bit easier when it comes to investing and your personal finance. Every Monday I post this update of the key 3 headlines that you need to know from last week. So let's jump into what they are. The first one is all about the ongoing war in the Middle East and what that means for oil prices, stock markets and your investments. It might come as absolutely no surprise to you that stock markets aren't looking superbly happy after the 5th week in a row that there is still conflict and war in the Middle East, and without really signs of that coming to an end. The US stock markets are looking particularly unhappy, but it's certainly not exceptional. The FTSE 100, which is the UK market, along with the Euro stocks, the European markets, as well as Asian markets, Australia and New Zealand, are all down relatively significantly over the last month. When I say down, what I mean is those indexes are lower by 7 to 10%, depending on which one you're looking at, from the previous month. And when you then look at year to date, they're also mostly now all down. So gains from an investing perspective are not brilliant. Now, some would argue, given the potential threat of war and also this war and what it means for oil prices, which I'll come on to, it's not actually that much of a drop, because oil prices are at nearly double what they were at the beginning of the year. They're now hovering back around the $110 mark, which is a basic measure that we use of a barrel of Brent crude. The $100 mark is really generally seen as quite psychological, so once that tips and we then go over that, people do then tend to start to panic, which means that investors then tend to start to sell off within the markets. But even that, oil being double what it was at the beginning of the year, is nothing when you compare it to other major shocks and other major oil crises where it's triple, quadruple or even more. You get the idea. It's still on a global scale, and looking back over history, seen as a relatively minor response, even if it doesn't feel like it to all of us, right? It's also worth noting, and this is maybe the crucial part behind all of this, is that whilst yes, we might start to see, for example, the price at petrol pumps go up, we might start to fear what's going to happen with energy prices when it comes to heating our homes, and therefore other products as well that use energy. A lot of those impacts haven't yet been felt, because often energy is forward bought, or at least oil, gas and other major resources that are used for energy creation. So at the moment, it's kind of priced in, and as a result, consumers, and therefore a lot of investors, haven't yet felt the full pain of what that might be. It's all just kind of an imagined future. And it seems to be that we've kind of reached a tipping point, where actually at the outset of this conflict, it seemed that perhaps this was going to be short-lived. And that imagined future of energy prices going up, being higher for longer, there being potential shortages, bottlenecks and so on, well, it's not really going to last very long, so, you know, I'll hold my breath. It's the classic taco. Donald Trump pulls out when he gets scared and it's kind of all over and done with, essentially. But actually, 5 weeks in now with no real sign of an end and Trump threatening to put troops on the ground as well as further actions, it's starting to turn the tides a little, and the markets and investors are starting to think that could go on for a bit longer. Now, for me, therefore, there's 2 main outcomes to discuss here and what they mean for your investments. First and foremost, let's take the option that most people seem to have been following, which is this is all going to be over and done with relatively quickly. We see a bit of a period of a shock, which we've mostly all seen in our investments likely, and then the recovery is relatively speedy. There might be a few sectors that struggle, lag a bit, see some of those price impacts drag on for 3 to 6 months, but then it's done. The conflict is over and happy days, hunky-dory. We can all start to look ahead again to growth and any other problems that are going on within the world. Second option is that this actually becomes a bit more of a prolonged period of war. And what that generally means is that it's going to be more costly from an energy perspective. These oil issues don't look like they're going to be over and done with quickly, even if Trump reportedly takes the island that he's wanting to take in Iran, even if he puts troops on the ground, all of these issues that we're seeing in terms of heightened oil prices, reduced supply down the Hormuz Strait are likely to remain. And what that means is that we're probably going to see a prolonged period of economic uncertainty, stock market slowdown, and some sectors that hugely rely on those global shipping supply chains, on energy prices, all suffer a little bit. If we see higher inflation, we'll likely see the same felt through to our investments. So that period of 3 to 6 months of brief recovery and then boom, we're back on again, might look a little bit longer. Again, depending on how long that war lasts, none of us have a crystal ball, so we don't know. So what that might mean for your investments is that you need to prepare for perhaps not such an exciting year as we've seen in the past, and maybe a prolonged period of slightly slower growth. I'm not saying no growth, because there's always winners and losers, but it may well mean that we do need to look at that long-term view even harder and remain focused on that, whilst those with a short-term view may be looking for those sectors such as defence, such as renewables, which I'm going to come on to talk about, such as arguably even tech as well, that are perhaps going to thrive more in a difficult environment. And talking about renewables, this brings me onto the second headline of the week, which is all about renewable energy and how this might be a winner during a tough time for oil. Oil prices soaring generally means that consumers feel the pain when they're heating their houses and using energy for whatever else they is that they use their energy at home. Octopus Energy, which is a privately owned company in the UK, has reportedly seen inquiries around solar panels absolutely surge. And it kind of makes sense, right? Because if people have got solar panels in their house, then they're making their own energy. No one can take away the solar rays. They might be able to take away their oil, but they can't take away their sun energy. And if they're generating their own energy, they're much less dependent on some man who they didn't even vote for, who lives in a different country, who suddenly decided to invade a country that they also don't live in. It's been a tough old year for renewable and, frankly, any other green-based investments, thanks to that man that lives in a different country that we didn't even vote for here in the UK or elsewhere, or even indeed in the country in which he lives. Donald Trump has been pretty outspoken in his views on climate change and notably the lack thereof, and has even cancelled some major wind farm developments as well as other attempts at introducing more renewable energy into the US. This has greatly impacted the share price of many US-based more renewable companies, and indeed even those across the globe as well. But actually, if you look at the share price of some renewable energy companies in Europe, for example Orsted, the Danish wind-based company, and Vestas, also Danish-based wind company, and other renewables as well, they both have other renewables within their portfolio, both their share price for the last week is looking a bit healthier. And I can't help but feel that this might be as a result of consumers starting to pivot away from the idea of our dependence on oil and actually our need, once again, for renewables. Now, of course, it's not gone away for everybody, but it's certainly been a fear amongst investors that if we've got Trump in power for 4 years and this anti-climate rhetoric continues for that length of time, what is that going to look like? Actually, he might have done a bit of an own goal here and really given some of those renewable energy companies, particularly not based in the US, the boost that they very much needed when it comes to their share price. So what does this mean for you and your investments? Well, crucially, what it means is that if you do have this kind of exposure in your portfolio, then great, things might be looking up, particularly if you've held on over a rough year. For those that don't necessarily have exposure to this in their portfolio, if you are thinking long-term and you're thinking alternatives and actually what has longevity, this might be yet another argument for that green route. Although it might not be particularly fruitful right now, and you might have to bear that in mind, it could be something that some may consider. And last but not least, the third headline that you need to know about for your investments is all about tech woes, and notably the legal case against Meta and Google. The case took place in LA, and it was a 20-year-old who brought the case against Meta, who own Instagram and Facebook, and Google, who own YouTube. Essentially, the case focused on this 20-year-old woman who argued that actually her childhood had been greatly impacted by social media in a negative fashion. And unfortunately, or fortunately, Meta and Google lost the trial. and they were found liable for exactly what she was pushing for, which is that they knew of the damage, the harm that their platforms cause, and they failed to let consumers know of this. Now, some online are likening this to the tobacco cases that were seen in the 90s, to the kind of free-for-all that then started to take place, where actually it really was realised quite how dangerous tobacco was, and the companies that were promoting it knew this was all uncovered, and the rest is history. Is this the turning point for the likes of not just social media platforms, but also AI? We're very rapidly seeing the potentially damaging effects of AI on children, on adults, the addictive tendencies it might have, and so on and so forth. Where does this mean that they can go with that based on this legal case that could open a whole Pandora's box of other legal cases across the US and across the globe as well? We've already seen Spain and Australia decide that actually social media is no longer appropriate for under 16s. And I can't help but feel other nations are going to continue to follow suit, making it ever harder for these social media companies to make profits, continue pushing themselves to the next generation, and of course continue to work in the way in which they do. Now, the irony is not lost on me that I'm talking to you through various different social media channels. It's kind of how we live, right? And it's not necessarily super easy to get rid of. And also, there are benefits to it, and we should talk about them in the same time that we should talk about the negatives. But when we're looking at this from a you and your investments perspective, what this could mean is all that chatter about the AI bubble that we saw at the beginning of the year before the conflict kicked off in the Middle East has not gone away. It's just gotten quieter because something else has become a bit louder. And actually, I really think this might be another part of the tail, another kind of dragger of the overall AI growth, because it was the potential that it was overvalued. Then it was the fears of how it would make money. And now if it's fears of they can't develop because it's actually really dangerous, they're going to face huge potential legal fees. Where does this take them? And what does this allow AI to do? Who knows? I don't have all the answers. We could debate it, I'm sure, for hours. But what I think it really means, and what we need to focus on from an investing perspective, is that diversification is absolutely key. Because if we've gone all in on tech, actually the way that tech is going to look is likely going to change. It's going to have to if it continues like this, with different legal cases and with outcomes that are essentially harmful for humans. Just look at where tobacco went. There's always winners and losers in every scenario. It's just about keeping up, keeping track, and making sure that you have that long-term diversified view within your portfolio. But there's the breakdown of the 3 major headlines that you need to know and what they mean for your portfolio. Do make sure that if you enjoy these videos, give me a like and a subscribe. I'll be back next Monday. If there's any headlines that you see in the week, you can always drop them in the comments section of these videos, and I'll do my best to weave them in and give them a little bit analysis as well as to what it could mean for you and your investments. Have a great week.